The simplest answer to this question is given by what we call the monetary base, which is the total amount of currency. If you got your hands on all of the dollar bills and coins there are, you'd have about $6.4 trillion. About 4.2 trillion of that is sitting in bank vaults and in the reserves held within the Federal Reserve. So only about $2.2 trillion is actually in circulation. But this number is far from a satisfying answer to our question. That's because it is nowhere close to the answer you would get if you went around and asked everyone how much money they had. That's because a lot of the money we have has been created by lending. If you have $1,000 in your savings account, the bank has lent out a good portion of that money. If we ask people how much money they have, you'll count that $1,000, but so will the person it is lent to. And so, if we want a functional understanding of how much money there is circulating in the economy, we need to take this into account. The money supply is the total amount of money in circulation or in existence. We have three main measures of the money supply. The monetary base measures the total amount of currency in existence. That includes all cash and coins, both in circulation, meaning in the hands of the general public, or sitting in bank vaults and the Fed. Then we have two measures which economists saw fit to bestow the inspiring names M1 and M2. Both M1 and M2 are only focused on money that is in circulation. So M1 includes only the cash and coins in the hands of the general public, but adds to them the money in people's checking accounts and savings accounts. Since deposits made into checking and savings accounts can be lent out by banks, this will capture some of the money created through the process of lending. M2 goes further. It includes everything that is in M1, cash, coins, checking accounts, and savings accounts, but adds certificates of deposit under $100,000 and individual money market accounts. Certificates of deposit are a kind of savings account where a person agrees to deposit money with a bank for a specified length of time. The money in this account earns a set amount of interest each month, but the depositor agrees not to withdraw the money before the agreed upon time. Money market accounts are similar. They are savings accounts which usually have a minimum required balance and sometimes limits on the size and frequency of withdrawals. But they also pay better interest on your savings than regular savings accounts. The idea behind M1 and M2 is liquidity. They're measures of the money people have available to spend. When something is highly liquid, that means it can be quickly converted to cash and used for purchases. If something has low liquidity, then it is harder to sell it for a fair value at any time. Cash and coins are the most liquid, as they're already cash and available to spend right away. It's also very easy to spend money in your checking account or savings account. These days, most banks give you a debit card to spend directly from the accounts. In the old days, you had to write in cash a check. But what makes this slightly less liquid than cash is that the bank could freeze your card and make claiming the full value of what is in your account a little more difficult. Below that are money market accounts. These accounts are usually offered by banks or other financial institutions, and they impose certain requirements like maintaining a minimum balance in exchange for paying you a higher interest rate on your savings. Money in these accounts is safe, but the requirements might make accessing it right away to spend a little more difficult. Similar to that are certificates of deposit, where a bank will pay you a fixed interest rate if you agree to deposit your money for a set amount of time, like 1 year or 10 years. The longer you agree to keep your money deposited, the higher the interest rate paid usually is. Money placed into CDs is also very safe, but the delay in getting it back makes it less liquid. M1 includes only the highly liquid assets, cash itself, and the stuff in regular bank accounts. M2 includes those as well, but adds some things that are very liquid, like small money market accounts, which have weaker limitations, and short-term certificates of deposit. As you might guess, there is also an M3 and an M4 and so on, which allow for longer time periods on those CDs and other deposits. But if you went around asking people how much money they had, they would probably want to include any money they have in stocks and bonds. But these are not included in our measures of the money supply. It's pretty easy to sell your stocks or bonds and get some cash pretty quickly, so they may seem like pretty liquid assets. The problem is that the value of these assets is not set. It can fluctuate. When you put your money in a CD, you know exactly how much will be there in 6 months because the interest rate is known and there's no risk of losing your money. That isn't the case with the stock market, so those gold balances don't get included. The same goes for any other assets people might be holding, like cryptocurrency, NFTs, or just boring regular real-life artwork, which is often used as a store of value. Here's a look at M1 and M2 since 1980, going until 2021. You can see that M2 is unsurprisingly higher than M1, since it includes the same things as M1, plus some other stuff. But in May of 2020, there is a dramatic change in these measures, as we can see if we extend our graph beyond that point. This has nothing to do with the pandemic or money creation. If you look in older textbooks, you will see that savings accounts were not part of M1 before May of 2020, but they were still part of M2. Savings accounts used to be more like money market accounts with minimum balance requirements and strict limits on withdrawals. But these days, most banks will give you a separate debit card so you can freely spend money right out of your savings account. The degree of liquidity has changed, and so the powers that be decided it made more sense to start including those savings accounts in M1. One way to think about these two measures of the money supply is that M1 is a measure of how much money people have available to spend right now, today. And M2 is a measure of how much money they could put together if you gave them a little time to get their short-term deposits back from CDs and money market accounts. So the next time a 5-year-old asks you how much money there is, you can put them to sleep, explaining how that depends on if you go with the monetary base, M1, or M2.